down 56.3% in 2022. Is Bill stock a buy for 2023? I'm going to answer that question in this video, so stay tuned. The first thing I want to look at is Bill.com's quarterly revenue growth, and this is one of the fastest growing companies in the market today. In the most recent quarter, it grew by 94.28%. That was down from the lofty growth rates of over 150% a few quarters ago, but still explosive nevertheless. Now, the company's not growing like this organically. It's making acquisitions, and that's making its growth look faster than it would be otherwise, but it's still growing, and that's part of its strategy to do these kinds of acquisitions to kind of bolt on its existing business and make it grow faster and faster. The company helps small businesses with its payments, and um, it's a rapidly growing industry. Competition is limited. It's mostly competing against Microsoft Excel in this regard. Microsoft Excel has some accounts payable, accounts receivable things in there. And so it can continue growing like this for several more quarters. But it's one thing to grow a company quickly, it's another thing to grow profitably. So let's look at its operating income over the trailing 12 months. And what I see here is troubling. On the top here, trailing 12-month operating income is going in the wrong direction. As it's making more revenue, it's losing more in operating income. That's not a trend I like to see. I like to see some kind of scale economies. In this case, it's more understandable because its strategy is acquisition based. Takes time to digest these acquisitions, and it's costly. Still, I want to see some evidence in this regard, and I'm not seeing that here. Bill's operating income loss of 330 million in the trailing 12 months is just getting worse over time. And if we look at the operating margin over the trailing 12 months, negative 43.83%, but at least the margin has improved over the recent two quarters. At least the losses in terms of percentage is decreasing. I'd like to continue to see that trend diminishing the percentage loss in terms of operating income. The next thing I want to look at is cash flow from operations, because a lot of times these tech companies are able to generate positive cash flow by paying a lot of its employees stock-based compensation to earn positive cash flow, and that is the case here. Even though Bill was losing a lot of money on the bottom line, it was positive 21 million in terms of cash flow from operations. Now, the counter metric to look at when you see this difference between operating income and cash flow from operations is shareholder dilution, because it's paying so much in stock-based compensation that's increasing the share count, which is potentially dilutive to shareholders, which means you're going to get fewer earnings per share when or if the company ever becomes profitable. And that's exactly what's going on with Bill.com. If we look at the average diluted shares outstanding, it had only 60 million shares outstanding in 2019. That jumped all the way up to 105 million shares outstanding in the most recent update. So more than two-thirds increase in average shares outstanding. A lot of dilution here. It could be using a lot of it could be using stock to make these acquisitions. It could also be paying employees in stock-based compensation. So it's a lot more shares outstanding. When it actually becomes profitable, you're going to have to split your earnings with more shares. Finally, let's look at this stock's valuation. And so I was able to get a forward PE projection and a price to free cash flow, because we mentioned it was getting earning positive cash flow by paying stock-based compensation and stock for acquisition. But these are less informative because it hasn't consistently earned profits, and it hasn't consistently delivered free cash flow on the bottom line. The more informative metric would be the price to sales ratio, and trading at a price to sales of 15, it's the cheapest that it's been going all the way back to January of 2020. It reached an really exorbitant valuation, price to sales over 90 at one point in 2021. I feel that's unjustified. That was unjustified. But a lot of SaaS companies were trading at exorbitant valuations in 2021. They've come back down to reality in recent times as investors have shunned these unprofitable growth stocks. So even at a price to sales of 15, the stock is not cheap. And I would say to answer the question if it's a buy for 2023, I'm going to say no, the stock is not a buy for 2023. I want to see more progress in terms of decreasing the operating profit margin loss uh, compared to sales, and I want to see a less decelerating in terms of top line, and I want to see more progress in terms of cash flow from operations. All right, that's all I've got for this video. Thank you for watching. I'll see you next time. I want to thank the Motley Fool for sponsoring this video. Visit fool.com/parkev for the 10 best stocks to buy now.